Traders, what's up? Welcome to this course. Welcome to this channel. All right, my name is Cole. I'm the head trader here at the Free Trading Academy. And just like the name suggests, this course is entirely free from start to finish, okay? The mission here is to make trading as accessible as possible to as many people as possible as we can throughout the world. All right, and of course, we will be teaching you how to make an average of $1,000 a day, trading currencies, indices, and commodities, all here in the Forex market, okay? I'll be teaching you the strategies that I use to make consistent returns for myself and for my clients. I'll also be teaching you how to protect your account and your equity and your capital with proper risk management techniques, market manipulation, how to watch out, protect for that as well, okay? And obviously the most important and the most fun part, how to trade with other people's money so that you could take this from a side hobby to a full-time lucrative trading career, okay? It absolutely can be done, and I cannot wait to show you how to do that. Okay, so we're gonna go pretty fast in this course, all right? But the good thing about it is it's all free. It's all here on YouTube, so feel free to watch, rewatch, take notes, okay? Because none of the content is going anywhere, okay? So thanks for joining us. Happy trading. Let's dive in. Traders, what's going on? So you know a little bit about me, who I am, what this course is about. So let's get into it. We're talking about the intro to the Forex market. So if you've been trading for a little bit, you're probably seeing this. You're like, man, come on, skip it. I wouldn't recommend it. I mean, you certainly can if you want. If you've been trading for years, obviously you know about currency pairs, what drives the market. All that is really what we're going to be talking about. This obviously is for the newer traders, people who are new to Forex or just kind of, dabbling in this asset class. So let's get in. Intro. All right. What is the foreign exchange market? All right. Foreign exchange, or Forex for short, allows institutions and individuals to buy and sell currencies for hedging and speculative purposes. All right. So we are retail traders. You'll hear me say that many times throughout this course. That is where we fall into. Okay. There are institutional traders and there are retail traders. Retail traders are essentially anybody who is not controlling billions of dollars in capital at one time. So you're talking hedge funds, brokerages, investment banks, central banks, people like that. So we trade and we speculate on the value of one currency appreciating against another currency. That this is why currency pairs are traded in pairs, and the discrepancy in value is how we make a profit. All right. So this market is an interesting market. So unlike, for example, the U.S. stock market, Forex is open 24 hours a day, 5 days a week. You have sessions that break up throughout the day, which we'll get into in a few slides. But what a lot of people love about this market is there's plenty of opportunities to trade. Now, the downside of this is it takes discipline that you do have to cultivate over time to not be always on your computer or always on your phone, chasing price, looking at potential entries, because it could get very easy to just totally get sucked in, and this becomes your whole life, which defeats the purpose of trading, right? You want to trade to be able to open up opportunities and give yourself time to spend with your family, your kids, do other things that you enjoy. So, but that is a great thing about this market. It virtually never closes except for on the weekends. And as I said earlier, currencies are bought and sold in pairs. We profit off the appreciation of one pair against another. Okay, so on the left here, you have a little chart. These are the major currency pairs. So these are considered major because they represent the biggest economies in the world. Basically, any currency pair that has a US dollar in it that's on this list, you'll notice all of them have US dollar in the list, is considered a major. And that's because the US has the largest economy in the world. And then these economies, Euro, this is the Eurozone, JPY, Japanese yen, GBP, Great British Pound, CHF or CHF, Swiss franc, and then CAD, Canadian dollar, AUD, Australian dollar, and ZD, New Zealand dollar. So these are the largest economies in the world. These make up the lion's share of the transactions that go on in the foreign exchange market. So these are considered the majors. All right. So when you're first starting out, it's recommended to start off on these pairs, and that is because they're very liquid. They have a nice balance of liquidity to volatility, which means that there's a lot of money coming in and out of these transactions. They move quite a bit, so you'll find some good trading opportunities. There's also a lot of institutional people that are trading these pairs, which means that these pairs should respect key levels and turning points, which we will talk about in the following videos. All right. So keep an eye on those pairs. Again, take a screenshot of that, or write that down. These are the ones that you definitely want to start off on. Okay. So currency quotes. So when you buy and sell a currency, we know now they're bought and sold in pairs. Okay. So what you'll see is Euro USD, for example. All right. So what does this mean? Like, what am I doing here? So if a Euro USD is trading at $1.13, some change here, so 1.1302, then you have a base currency. So your base currency will be the country symbol that comes first, and then your quote currency will be the country symbol that comes second. All right, so what this is representing here is 1 euro is worth 1.1302 US dollars. Okay. So if you were to go to an airport, if you're traveling internationally, all right, and you go to the airport, you go to the bus station, wherever, and you see these exchange rates, this is normally what you'll see. All right. So if you're carrying US dollars and you're trying to exchange that money into euros, then this is what the exchange rate will be. Okay. On the right here, you'll see the quotes. It's a more detailed breakdown. This is what it looks like when you download MetaTrader 4, which is a terminal that you will conduct your trades through. We'll talk about that at the end of this video. But you have two prices here. So you're probably wondering, what is this? So you have the bid and the ask. All right. So the bid is the price that you get in at if you're selling a currency pair. All right. And the ask is the price that you get at, or you get in when you're buying a currency pair. All right. So just a little bit more nuance there. But these are how the trades are, or excuse me, the quotes are set up. They're always quoted in pairs, and we are buying and selling pairs at the same time. All right. So pips and lot sizes. How do you make money? All right. So we know currencies. We know that they're quoted in pairs. How exactly do we profit off of the price fluctuations? All right. So a pip is short for a percentage point or a price interest point. So a pip represents a tiny measure of change in a currency pair. So think if you're a futures trader, for example, all right, and you trade the treasury bonds, all right, the bonds are measured by ticks. All right. So somebody says, oh man, I had a 9-tick win on the bonds. All right. That's just a measure of price as it's fluctuating on that market. All right. Points, same thing. If you turn on CNBC or, any of these like Market Watch type channels, they'll talk about how the Dow rose 100 points or the S&P fell 200 points or something like that. So each of these instruments has a way to measure their movement. All right. So pips it's the same thing for Forex. So we measure movement in pips. All right. So example here, because I know that's kind of, like what does that mean? Give me the dollars and cents here. So assume that we have GBP USD over here on the right. So this currency pair is Great British Pound US dollar. All right. And so the direct quote is 1.35361. All right. So for $1, you could buy 1.35361 pounds. All right. So if there's a 1 pip increase, then the price would now go up to 1.35371. Okay. So we're going to talk about lot sizes on the next slide. But again, so pips are measured, it's the fourth number after the decimal. So this is why this one is highlighted right here. This is the fourth number after the decimal. All right. So now taking that information and we transition to lot sizes. So this is how we actually calculate how much we could win or profit or lose per trade. Okay. So a lot is a unit measuring a transaction amount. All right. So again, futures, you have contracts. If you're trading stocks, you have shares. All right. So, I made, or I placed a, you know, 2-3 contract trade on the ZV on the futures market. All right. So same thing. I placed a 5 lot trade on GBP USD in the foreign exchange market. All right. So lots allow you to buy thousands of units of currency at one time. All right. So as you saw in the previous slide, a pip is not really, I mean, it's a minute fluctuation. I mean, you're talking fractions of a penny. All right. So how do you profit off that? You have to buy thousands of units of a currency to actually make a profit off of that minute change in value. All right. So a lot, you have four different lot sizes. You have a standard lot, a mini lot, a micro lot, and a nano lot. All right. So a standard lot represents $10 a pip when you're using USD, Euro USD, or GBP USD, or Australian US dollar, or New Zealand US dollar. Anytime the US dollar comes second, all right, then essentially you get a 1-to-1 return. So that's basically for one pip in either direction, you're either making $10 a pip, $1 a pip, $1 a pip, 10 cents, or 1 cent. All right, 1-to-1. All right, a mini lot represents a $1 pip movement when using any of those pairs that I just mentioned as a base currency. Micro lot is $10 a pip, and nano is 1 cent a pip. All right. So, if you go to say like the daily ATR, daily range on some of these currency pairs, you'll see, GBP USD is a pretty volatile pair, right? So it could move anywhere from 100 to 150 pips a day. Now, if you look at it objectively on the in the grand scheme of things, you'll see like that is maybe a change of a cent. So you're like, well, that doesn't even make any sense. Like, why are so many people trading this market? The price is moving pennies, at most a day. Well, it's because you have lot sizes. So, if GBP USD goes up 100 pips in one day, and you got in on the bottom of that, and you're trading one standard lot at $10 a pip, well, you just made $1,000. All right. So this is why understanding lot sizes is important, especially when you're talking about risk management, managing your money, to make sure that you're not overexposing yourself on your account. So if you have a smaller account, then you should not be trading a standard lot. Okay. And by smaller account, I'm talking $1, $2, $3, $4, $5,000. You should not be trading standard lots. Okay. You should be looking at mini lots, because now you're talking $1 pip, and that'll allow you to, just basically give you a little bit more wiggle room in the market. Okay. All right, so let's move on here. So currency pair correlations. All right, so it's good to know which pairs move in tandem and which pairs move opposite. All right, because there's so many currency pairs to trade. All right, you don't want to get in to multiple trades where, say, for example, you're buying Euro USD and you're also buying USD Swiss franc. All right, so you could see that Euro USD over 1 month, 3 months, 6 months, and a year, the US dollar and Swiss franc moves basically in the opposite direction. All right. So this is very helpful, because if you have a trade set up on Euro USD, say for a long or a buy, all right, then you know that most likely USD Swiss franc is going to be going in the opposite direction. So you might not even have to do that much analysis on this currency pair, because you know that, hey, if Euro USD is shooting up higher, then I could sell USD Swiss franc and I could really double my profits. Okay. So it could definitely help you. But if you are not prepared, or if you're just trading recklessly, then you could basically just be going against yourself. All right. Because you do not want to be trading in the same direction on two different currency pairs that tend to move in the opposite direction. Okay. Now, on the flip side of that, you also have currency pairs that move in the same direction. So you have Euro USD has a high positive correlation with GBP USD, with Australian US dollar, New Zealand US dollar. So if you have a setup on any one of these pairs, then you might have the same setup in the same direction on some of the other ones. All right. So again, can't stress this enough. When trading multiple pairs at a time, definitely make sure you are not buying two separate pairs that normally move against each other. All right. Because at that point, you'll basically be canceling each other out. All right. So this is a live screenshot of Euro USD on the left. So that's Euro US dollar, and US dollar Swiss franc on the right. All right. So you could see this is the same date. You could see here at the bottom. This move started on the same date. I think this spanned about 2 or 3 days. But the downward move on the left here started on June 16th. All right. You could see this upward move on the right, also start on June 16th. So these are two currency pairs that famously have a negative correlation, which means if one is going up, then the other one is most likely going down. All right. So you could even see prior to this sharp move here on Euro USD, price was kind of slowly grinding up higher, right? Now on the right, USD Swiss franc, and again, these two have about a 99% negative correlation, 98, 99%. Price is slowly grinding downwards. All right. So this could be very helpful again. So if you knew, we're going to talk about charting, we're going to talk about technical analysis, how to get in at the very best price. So if you were able to predict this downward drop, okay, then you could have also predicted this upward spike here and you would have doubled your money. So understanding correlations is huge. All right. Trading session. So as I mentioned earlier, the market is open 24 hours a day. I mean, technically there's like a 30-minute break after New York closes, but it's virtually open 24 hours a day, 5 days a week. Okay. So you have a lot of different markets, but the major ones are Sydney, Tokyo, London, and New York. These are the biggest ones that are followed. That's basically the consensus amongst most traders. You also have the Chicago Open. You have the LA Open. I live in Southern California, so I wish that was a big deal, but it's not. You have, I think, the Denver Open. I mean, you just have a lot of different markets that open throughout different times of the day. But again, the highest spikes in liquidity and volatility tend to happen around these four. All right. So most traders prefer to trade the London Open. That is generally the most liquid, the most volatile. And then also the New York session and London session overlap. So there's about 3 hours early in the morning when the London session is winding down and the New York session is just opening. So you have a period in time where the market is just moving. So that is a really great time, especially if you're a day trader, which means that you are somebody who takes, 3 to 5 trades a day. And after your session is over, you just call it. We're going to talk about that later as well. But that could be very advantageous for you. All right. But this is what a lot of people love about Forex though, is if you have, say example, a job where you work the graveyard shift and you don't have a whole lot going on and you have a computer, then, hey, you could trade the Tokyo session. You could trade overnight. If you have a kind of an odd swing shift, you could trade the opening of the London session. You could trade New York, for people who, kind of have more traditional schedules. So there's a lot of options. So, I would say if you're picking out which session you want to trade, that's definitely part of your trading plan. But take inventory of what your life looks like now. Are you able to trade overnight? What time do you have? And then just kind of work out from there. Are you able to trade early in the morning, et cetera, et cetera. All right. So who moves this market, man? I mean, the thing about Forex is it is a $6 trillion liquid market virtually every day. I mean, that's about the average. That's how much money is moving on a daily basis. That is a lot. I mean, that is a lot of money if you think about it. So who's behind all these people? Is it people like you and me? The answer to that question is no. I mean, we make up part of it, but we do not move it. So you have at the top, you have investment banks. So these guys make up over 50% of all transactions. So you have JP Morgan, B of A, Merrill Lynch, Goldman Sachs, Morgan Stanley, Citigroup, Deutsche Bank. So these guys, they have money, and they use that money to move the market as they see fit. You also have investment funds, and you have central banks. All right. So the relationship between the central banks to everybody is very interesting, because while the central banks may not have collectively the same amount of capital as investment banks, the central banks set the policy, the macroeconomic policy that moves the market. And these guys kind of like use their weight and their muscle to just enforce that. So we're going to talk about policy, I think, in the next slide. And then you have retail traders, which is us, people, again, like I said in the very beginning, people who are not controlling millions, billions of dollars in liquid capital. We are essentially riding the wave. And I'm going to teach you guys how to do that effectively throughout this course. All right. As I mentioned earlier, the central banks create the policy that drives the currencies. All right. So you have about 5 major things that you'd want to keep an eye out for. You have interest rate decisions, federal bond purchasing, GDP, inflation data, and jobs reports. Okay. So if you're wondering, like, why does interest rates make a big deal? All right. So if you have been, trading Forex for a while, you know that anytime the Federal Reserve makes an announcement, the current chair is Jerome Powell. Anytime Jerome Powell talks, the whole investing world drops what they're doing and they listen, because if he signals that they're going to raise interest rates, then that is going to send the markets into a frenzy. It took me a while to figure out why that's such a big deal. But again, so here's an example. Okay. So say the US, their interest rate is at 3%, and the United Kingdom's interest rate is also at 3%. All right. And suddenly the Bank of England, they decide to raise their interest rate to 4%. All right. So what will happen is a lot of the people with money in American banks are now going to want to withdraw their money and deposit that into a British bank, because they'll get paid a higher interest rate, because now the British banks are offering a 4% interest rate. All right. So in order to do this, they would need to convert their dollars into pounds that the British bank will accept, right? Because, what British bank would accept US dollars? And then since they're selling their dollars and buying pounds, the supply of the former and the demand for the latter increases, which is why the value of the pound relative to the dollar would increase. Okay. So whenever you see a country raise interest rates, that's been a hot topic during the pandemic. Their currency is going to shoot through the roof. All right. So when preparing for medium term to long term trade setups, look to buy currencies with higher interest rates against currencies with lower interest rates. All right. So a perfect example right now. Okay. So New Zealand is expected to raise their rates in August of 2021. So what's that? Just a month some change away. So while Japan's, on the other hand, should remain flat or in negative territory. So a good buy outlook post October 2021, if New Zealand decides to raise their rates, would be to buy New Zealand JPY. Okay, because the the value of the New Zealand Kiwi is going to be exponentially greater than the value of the Japanese yen because of that rate hike. All right. So definitely keep these things on your radar. Definitely be monitoring the major currency pairs for interest rate decisions. All right. A couple of resources to follow those news, because you're probably like, man, I've never heard of interest rate hikes. I have no idea who or what the Federal Reserve Bank is, and that's totally cool. But these are the 2 main resources that I like to use, Forex Factory and Daily FX. There's quite a few other ones out there, but I just like how these are Forex focused. You go to the site and it's boom, it's right there. You don't have to search for it. On the left, you could see kind of just like a screenshot of the homepage here. This is why Forex, did that on accident. Forex Factory is nice, right? Because as soon as you log in, to the homepage, you could see all the news, laid out for the day. Anytime you have a red folder event, that is something to keep an eye out on. It's basically like stop what you're doing, stop trading, and pay attention to this data right here. Yellow, it's not really that big of a deal. So yeah, these are the links up here. Just if you just type them in Google, then you will be redirected. So those are the resources. Again, guys, this is a business. I'll say that over and over again. Treat it like a business, and just like any business owner, they're always watching the market happenings in their industry. They're keeping up to date. So this is a great way to do that. Okay, so let's talk about brokers. All right, how do you actually place a trade? How do you just take your money to a currency exchange kiosk somewhere, and now you're a full-time forex trader? Technically, you could, but that would be very tedious. So brokers are people, companies rather, that give traders a platform for buying and selling currencies. All right, so you have really two major types of brokers. You have a dealing desk broker, which is in most circles considered a market maker. A dealing desk broker takes the opposite side of some of the trades. So if they can't find you another trader to match you with, then they will trade against you. So I don't like that, because how could I verify that they couldn't find a trader? It's too gray for me. I don't like the idea of trading against my broker. I think a natural broker relationship is to, broker a deal, bring two sides together and you are the neutral party. So I'm not a fan of market makers. They stay in business because they tend to have lower fees because of that, because, trading against your clients is not really marketable. But, some people trade with them and they trade just fine. The second is the ECN, so non-dealing desk broker. These are generally more preferable because they don't take the side of the customer trade. They truly facilitate a broker transaction, meaning they bring a buyer and seller together every single time. So generally, these guys have lower spreads. Sometimes you might pay some higher fees, swap fees, if you're holding trades overnight or for a long term. But in the long term, I think it's a better deal. That's just my personal opinion. So on the right, you have just a snapshot. Just some of the main brokers. There's so many guys. There's so many brokers out there. I will share. I think it's either the next slide or the one after the one I'm currently using. But there's a ton of brokers out there. So ask around. Feel free to hit me up. I could point you in the right direction. But definitely do your due diligence because there are some ones that are not that great. So definitely just don't sign up with the first one that you see. All right. Leverage. Okay. So this probably would have been better to talk about earlier on when we were talking about lot sizes, lot sizes and pips. Right. But, again, so how are you able to profit from these minute price movements? So we talked about lot sizes, but even on top of that, most brokers offer you some sort of leverage, which in a nutshell means that you deposit money into a certain type of account, and based on the leverage of that account, you now have added purchasing power, which means that you could buy more currencies. Okay. So most currency pairs, as we know already, they move in the equivalent of pennies per day. I mean, maybe a penny per day. So if you don't have leverage, then you would make just a small amount on every trade. This market would be dead in the water, right? Like nobody would trade this market if on a 60 pip move, all you make is like 1 cent or a fraction of a cent. Nobody would trade that. So if you trade with, say, 50 to 1 leverage on $100 account, now you have $5,000 worth of purchasing power that you can control currency with. So leverage is nice. Leverage is very nice. Leverage makes okay traders into great traders. Leverage makes hobby traders into full-time traders. Leverage is a good thing. The bad thing about leverage is it amplifies your wins but it could also amplify your losses. Okay, so if you're trading reckless without any risk management, then you will blow your account very quickly. Okay, so at the bottom, like I said prior, KOT Forex is the broker I'm currently using on my private accounts. They're good people. I like them. They're pretty reliable, very reliable. Haven't had any issues. So I'm not getting any kickback from dropping a plug. I'm just saying that's what I'm using now. So feel free to check them out. If you don't like them, cool. But that's who I got. So yeah, take a look at this chart. So again, if you have $1,000 invested into a Forex account and your broker is offering 200 to 1, then your purchase power is now $200,000. So again, it's nice. It's nice to use, but just be careful with it, because if you're trading reckless, and leverage will really burn your wallets. All right. Charting. So this whole course is really about, how to get on these charts and forecast price movement. I use TradingView. That's my software of choice. That's the software of choice for most traders, I could say. What I like about TradingView is you don't have to have a specific license code. You don't have to go and download something. It's open. I was about to say open source, but it's not open source. It's open to use on the web. You could also download it on your iPhone, Android. It's just real user friendly. I also like that they have a trade ideas community. So if you're just kind of like, I don't know, bored, just scrolling around, you want to see what some other traders are talking about. Other people could post ideas that they have on where price on certain instruments may be headed. So that's pretty cool. And then of course, you have the price alerts, because again, we want to be able to enjoy trading. We want to be able to enjoy the freedom that trading brings to our lives. So part of that is not being glued to your computer, watching price like a zombie, right? Like you want to have systems in place to where you get alerts, and then you could jump in and make your trades. All right. You could also integrate it with some brokers. Unfortunately, mine does not integrate. But if you trade with a select few that they partner with, then you can make your trades directly through the platform, which is nice. So I got a link in here. Let's check it out. All right. So yeah, this is the home page. Again, you could see you have live quotes here. You have, somebody's markup on gold. You got some Bitcoin news, stock news. So it's just a nice hub, man. It's just a nice hub. Any instrument, stocks, indices, commodities, bonds, currency pairs. I like it. It's really cool. Let's see what the ideas are talking about here. Yeah, so I mean, they're talking about indicators. I mean, it's just a great place to soak up some knowledge, especially if you're a new trader. It's a really great place to soak up the knowledge, man. So back to charting. So that was TradingView. Go ahead and check that out, guys. I mean, again, it's not like an official endorsement. That's just what I use. That's what most traders use. All right, so you probably noticed, if that was your first time looking at a chart, you're like, what was I just looking at, right? So most traders use candlestick charts. Okay. What I enjoy about candlesticks is they tell a nuanced story of price action between the buyers and the sellers. All right. So as opposed to a line chart where you just have a boring line, just up and down, you really don't know what's really going on there. You just know the open and the close, the price, and that's pretty much it. You could kind of tell the overall direction of a trend. You could tell some major key levels, but each candle really does tell a story. So once you learn how to read candles, then you're good. So each candle represents price action happening within a certain amount of time. All right. So down here in the bottom left corner, let's assume this is a 4-hour chart. All right. So each of these candlesticks would represent 4 hours worth of price action. All right. After 4 hours pass, then the new candlestick begins to print, and you could see in real time actually what is happening. All right. So candlesticks are helpful because they're used to determine possible price movements based on past patterns. All right. So we're going to talk in great detail about candlestick patterns. certain patterns that form at various key levels and what that could mean for entries. Okay, but an example here. Okay, so this is a bearish Marabozu, which signifies a continuation pattern. So this candle right here doesn't have any wicks or shadows. It's just pure momentum. All right, so we could see here that we're in a downtrend. All right, so if you see a candle like this form, then you know that this correction move, these green candles, this correction move is now over, and now the dominant trend will continue. All right, so that's a good thing about candles. You just don't get that on a line chart. All right, you wouldn't be able to see this actual candle on a line chart. All right, so after seeing this print, then you know, okay, I could get back in the sell, take my shorts, and write it down. Short, by the way, means you're selling. All right, so I hope you didn't think that I was actually talking about literal shorts, but I can see how you would make that connection. All right, so on the right here, you have the bullish candle and the bearish candle. So you'll notice here, back to the left, so I'm kind of going back and forth. You have green candles and you have red candles. So red means price is going down. Green means that price is going up. Okay. This part right here is called the body. All right. In the body, you have the open, which is basically the bottom of the square of the body. All right. This is the open price. At the top, you have the close, and then you have these wicks here that indicate the high and the low. All right, so let's go back to our chart. So let's look at this candle right here. It has a very small body. Okay, so that means that price at one point was all the way up here. Okay, at one point it was all the way down here, but it actually opened and closed in a very small area. So this means that there is some indecision in this area. We don't know if buyers are going to take over. We don't know if sellers are going to keep the price going down. You just don't know. Okay. Let's see here. Let's see what else we could find. Have some more indecision candles over here. I thought I saw a hammer in here somewhere. All right. You have an engulfing candle right here. So this indicates that buyers have now taken over, at least for the time being, have high momentum to the upside. And you have another green candle to continue that movement. All right. But yeah, these are just great to trade. These are great to trade. I know people have their own style. But again, the more information you have when trading, the better. All right. So you want to have as much information as you can that fits with your trading style, that fits with your trading plan. And that will be able to give you some good entries. Here it is right here. I lost it. So this right here is a good example of what's called a hammer. We're going to talk about these a little bit later, or a pin bar. All right. So this wick right here, this candle, this means that price at one point got all the way up here, but the sellers pushed it back down and it closed red. So it closed bearish. All right. So we're in a downtrend. This candle right here could be a good indicator that the downtrend will continue because there's selling pressure still in the market. And you do see that the trend does continue downward. So again, just another example that candles could really give you a good nuanced story of the action that's going on behind the scenes with the buyers and the sellers in the market. All right. MetaTrader, MT4. So this is how you will place your trades. You sign up with your broker first. So that's why we talked about that. After you have a broker, then you will download the terminal either on your desktop or on your laptop, or excuse me, laptop, desktop, or your phone. You see they also have a tablet application. I would just put it on all your devices because you just never know when you might have to jump in a trade. Good to be mobile, good to be flexible, and it's available basically on all platforms. So I'm going to exit out of here. I'm going to show you guys an easy way to download MT4. Okay. All right. Okay. So here is the homepage for my broker, KOT Forex. Kings of Transparency is kind of corny. I don't know who came up with that, but they're good, man. They're good folks for real. So when you download when you create your account, there should always be somewhere on the home page or maybe on your account page where you could download MT4. So this is good because it's like your broker's version of MT4. You don't have to, because if you download the general MT4 from their website, then you have to like type in all your broker information. You have to scroll through all these brokers. They might have it, they might not. So it's good to just download it straight from your broker website. All you have to do is just type in your account number and your password, and then you're in. Okay, so that's a good one. So you just click download MT4 for Windows, and then you'll have your little terminal here. So this is what the actual desktop or laptop trading terminal will look like. All right, you have all of your currency pairs here on the left. There's some that they don't show, so you could just go in here and click symbols and find the right one. There's a ton of MT4 tutorials, so I'm not gonna jump down that rabbit hole right now. But this is what it looks like here. All right, if you want to place a new order, all right, just click on new order, choose whatever currency pair you want. You have your stop loss, take profit, and then the order type. Okay, we're going to talk about orders just in a moment. And just like that, boom, you're in the market. So this is real nice. It's real handy. A lot of people like trading from their computer. I kind of do both. I like, I place trades from my computer or phone, but I definitely do all my charting on the computer because I just confuse myself too much doing it on my phone. All right, guys, let's talk about order types now. Couple slides left. We're almost at the end, so just hang in there. Okay, so there's 3 main types of orders. You have market orders, pending orders, and stop loss orders. There's a lot of other ones, depending on which asset class or instrument you're trading. You have OCO, just a lot of different orders. Okay, end of day, which you could do a little bit of that with Forex as well, but pretty much everybody uses the same 3. This is just the way the market moves, and you really don't have to get too complicated with it. So a market order is just an instant entry. It's just price is trading at this level. This is a price I want to get in at. Get me in right now. Okay, so you could either market buy or market sell. All right, I would say for me personally, about half the trades I make are market. That's just usually because I'm looking at the market. I'm live trading, have everything set up right in front of me, so there's no need to use a pending order. A pending order is waiting for price to reach a certain level. So basically, it's like if you are looking to sell, for example, okay, and I wish I could draw on here. If you're looking to sell and price is moving up, but it's not quite in the zone that you want to sell from, so you could place a sell pending order in your zone, wait for price to get up. It'll trigger that order so you could get in at the best possible sell price, and then price will fall back down. Pending orders are also good if you are, for example, if you just have a hectic life schedule, hectic work schedule, but you're like, hey, I want to trade, I want to do this, but I don't have the time to dedicate an hour or 2 in the morning or at night, but I still want to trade. So pending orders are good for those people. And then you have your stop loss orders. So stop losses, honestly, are probably the most important orders because they protect your account equity, and they just won't allow you to stay in a position forever that goes against you. Okay, so a stop loss, you could take your buy or your sell, and then you could place the stop order near your buy or sell. So if price goes in the opposite direction that you intended to go, and it hits this level, for example, then it will automatically take you out of the trade at a loss, but it'll be a small loss relative to the loss that you would take if this wasn't here, because price will just keep heading in the opposite direction, and eventually it would wipe out your account. The good thing about Forex trading is you can move your stop losses in real time. So going back to this graph down here, let's say that you got in at this level for a buy, and instead of going down against you, price goes in your favor. Okay, you can move your stop loss ahead of your entry. So that way now it's a break-even trade, or a risk-free trade, right? So you're really not risking anything at this point. Price is well ahead of your entry. You could move your stop loss ahead of your entry. So if price does retrace and touch your stop loss, you will get taken out of the trade, but you'll get taken out in a profit. So stop losses are um, a very nice type of order. It protects you. It could also, allow you to stay in a trade virtually risk free. All right, you don't have to worry about price hitting your target and then retracing, or getting close to your target and then retracing back against you. All right. So let's talk about pending orders for a minute. So you have 4 different types of pending orders. You have a buy limit, a sell limit, buy stop, sell stop. All right. So I'm a pictures kind of guy. Next slide, we have some pictures breaking this down. All right, on the left, you'll see your limit orders. All right, so a limit order is, if you remember the example that I gave, you have price. So the blue dot is price. Okay, let's go back to the sell example that I gave. All right, so blue dot is price. So let's say you wanted to get in for a sell, but price is not where you want it to be. You don't want to sell from this area right here. You want to wait until price gets up into this nice sell zone here. All right, so you can place your sell limit order, and then price will go back for your sell. All right, so limit orders, sell limit, it's an order placed above the current price action, in hopes that it will get triggered and then price will go back down. All right, buy limit order is the complete opposite, same thing, but just the opposite. It's an order placed below current price action in hopes that price will fall down. Sorry about that. In hopes that price will come down a little bit more, and then you could get in. So it's just basic principles. If you're buying in, you want to buy low, right? You want to buy at the lowest possible price, sell at the highest, and then same thing with the sell. You want to sell at the highest possible price so you could get a nice profit. All right. Stop orders are if you are trading, breakouts, something of that nature, and price, say, is trading near a major area. Let's talk about buy stop. So price is trading near a major area of resistance, and we're going to talk about support and resistance zones in a moment in coming videos. And price breaks through this area of resistance. Okay. So these are for more aggressive traders, because I like to wait for a retest. Again, we're going to talk about all those strategies in a moment. But if you just want to get in on the initial break, then you could have a buy stop order waiting at this level. And as soon as price breaks through that level, then the order is triggered and now you're in the market. Okay. So again, it's for aggressive entries. It's still able to get in at the best possible price. So a buy stop is an order placed above price and the price keeps going up. Okay. So you're in and you're going. Sell stop is the same thing. Sell stop is an order placed below current price action. And it just keeps on going down. So again, you normally use these around major price structures that are about to be broken, support and resistance, supply and demand zones that are about to be broken, and that way you don't have to worry about catching it live. If you know it's about to get broken, then you could just place your orders there, and your orders will get triggered, and you'll be in. All right. So these are the 4 pending orders that I use the most. Most people use these on a regular basis. And with these in conjunction, I'll go back with regular market orders. That's really all you need, honestly. It's really all you need to get into the market. There's some other creative stuff you could do, but for just folks starting out, this is really all you need to immerse yourself in. And honestly, even for professional, consistent traders, people who've been trading for a while, this is really all most people use as well. Again, can't stress enough the stop loss, guys. The stop loss is so important. All right. Do not ever trade without a stop loss. Always have that level marked off where you want to get taken out if price goes against you. All right. You will lose. It'll happen. It's part of the game. But again, this is a business, so always protect your assets. All right. And that is it, guys. I know this has been a long video. The next ones will not be anything close to this long, but I just wanted to do a high-level overview of the Forex market, who moves the market, different types of orders, patterns, how to go about finding a broker, just all the foundational stuff. All right. It took me a long time. I had to figure all that stuff out on my own. I really wish I would have had somebody to just kind of, condense it all for me. So if you have any questions, shoot us an email, freetradingquestions@gmail.com. If it's easier, you could reach out on Instagram at Free Trading Academy. Send us a message there as well. All right. This would be a great course. Super excited to put this together for you guys. Again, it's completely free. Give us a like, give us a share. And I just can't wait to hear the feedback. All right. As we progress through this. All right. So take care. Happy trading. And yeah, feel free to reach out with any questions. All right. Peace.